Good day, everyone. Well, the Fed's going to have to keep printing. We know this. History knows this. And currently, the 10-year Treasury yield is right about 2.89%. And we know that the yield fell since mid-June because the market thinks Powell may have to pivot sooner than later by halting hikes, given that inflation came in 0.2% under expectations across the board for both CPI and the core. But the CPI still remains at levels well above the Fed's target rate of 2%. The PPI also came in under expectations, while energy nosedived after spiking higher in prior months. Nominal wages are up, but when adjusted for inflation, wages actually fell, so they're unable to keep pace with inflation. The recession that's to come, that we're in actually, is likely to be deeper than typical recessions. And if you take a look at the first graph, shows that overall CPI bars together with this energy sub-index, you see that overall, we had a huge spike in all these values, and so there can be some backing and filling that we're now seeing across many different metrics. Lower oil and the soaring sales to inventory ratio suggests that inflation could then fall further. The only thing is heating oil is scarce, so the price of oil could start into a new uptrend. But nevertheless, commodity prices appear to be moderating after their big moves. And given all of this, the CME Fed futures is actually on about 50-50 par for a 75 basis points rate hike in September. That's the question: is what is going to be 50 or 75? And Powell had said it's data dependent, and I think the minutes that come out at 2 p.m. Eastern today are going to probably reflect that. So there probably is no surprises, but he's going to also emphasize that inflation's really high, so we have to keep raising rates. I think it's just a matter of not halting rate hikes, but whether it's a 75 or 50 basis point hike. And the other problem also with what Powell wants to do, I mean, he wants to hike 3 more times, and that would bring the Fed funds rate to a range of 325 to 350. But we may never get there because the U.S. debt clock, there's this 2 indications. First of all, you've got U.S. federal tax revenues that could end up being engulfed by the amount of debt that has to be serviced, just the debt interest alone. And that's why ultimately I showed a chart a couple weeks ago showing that whenever they hike rates since the late 70s, when they did spike, each bounce is smaller than the last because debt ultimately ends up becoming a bigger part of the equation. And that's why M2 never materially drops once debt reaches certain levels. And we're probably going to roll over in terms of the interest rates, or at least Powell's going to have to put a halt to them once markets start to really correct. And I give them 2 more rate hikes. I think we'll get maybe a 75 and then maybe a 25 basis point hike. Next 2 meetings, and maybe markets will start into downtrend. And maybe that gives the Fed just enough room to hike a 3rd time in December and bring their rates up to that 325 to 350. But I think we'll get a replay of what we saw in December of 2018. That is, the markets just wouldn't stand for it anymore, and they launched into a fairly nasty correction. Now, major stock market averages, I would say, well, right now we've got a cushion. They've rallied since June. So it looks like a dead bat bounce that we saw. That's pretty typical of, say, the year 2008, where the majors rallied for a number of weeks and quite strongly as well before they really rolled over. So yeah, you could argue Powell has room to hike rates until the majors retest and plumb new lows, and that could be three rate hikes away. Now, I would say there's one way out against markets retesting lows or plumbing new lows, and that is if CPI and the core inflation continues to fall due to the factors I've mentioned, while the recession shows itself to be a lot more serious, then Powell could be pushed into halting the hikes altogether, which would likely signal a major low if markets capitulated. Otherwise, if this happens before a retest, markets could shift into a sideways lackluster pattern, as they did in 2016. That was a year that rate hikes were halted all year. So I guess it comes down to the data, as he said. I mean, if the recessionary indications show real problems in the next, say, 2 months, then I don't think he's going to be hiking, say, in November. And the key will be he announces that he's no longer tightening the balance sheet. And that's what he did after the Christmas crash in 2018, which was the major low for both stocks and crypto, more or less. So I think, it's a question, watch those CME futures. Right now, it's pretty 50-50 split between 50 and 75 basis point hike in September. And keep in mind that globally speaking, the Bank of England is anticipating inflation to continue higher to the end of the year. And so they hiked by 50 basis points at their last meeting. That was the largest hike since 1995. And China's economy, meanwhile, is in trouble. So they just announced a surprise rate cut. So they're going against the grain. I don't think that's going to spark copycat global central banks to do the same, because other countries are really in trouble with their rates of inflation. And China kind of beats to its own drum anyway. So I think we're at least a few months away from any sort of halting of hikes, or maybe a shift toward lowering interest rates right again. Once we get that, I think that marks the major lows for stocks and crypto, if history's any guide. And I did send a chart, I'll send it again, and it just shows basically the high correlation between the price of Bitcoin and global M2. So in February of 21, global M2 peaked. And that was more or less the high for Bitcoin. I think it got up beyond 60,000, and it tried one last gasp later in the year to 69,000, but those metrics were all fouled up. I mean, the metrics were showing that the price rise to 69,000 was not really sustainable, or let's just say highly unlikely. So basically, we're just going to see right now, where things stand, probably a resumption to the downside. We have Bowman, who gave a speech at the market open. She's a very well-known hawk. She's the one who's been just, I think, a week ago was talking about how a 75 basis point rate hike is very necessary. Then we have other Fed chairs, members that are going to be speaking the rest of this week, and both of them they're all hawks. And then we got the minutes. So I think we've got some headwinds ahead for the markets, and also they're just way up in nosebleed levels. This seems like almost a logical place for a rollover. But again, we'll see, data dependent, right? So we'll have to watch those reports closely as they come out, and see if they boost Powell's case for being more aggressive on the rate hike side. Gil, how are you seeing everything?
Yeah, I think this stuff about inflation being over with, I think is a bunch of BS. The numbers we saw last week were all heavily influenced by dropping gas prices. And if you go to the store, you're going to notice that prices continue to rise, and food prices rose 13% in the prior month. So a lot of that was, all of that was masked and overshadowed by the drop in gas prices. So even the core rate benefited because there are other elements in that, or components in that are related to gas prices. So in other words, there are things where the price will drop if the price of oil goes down. Anyways, so I don't see it happening. The other thing is, and I think this is something that we need to reiterate time and time again, which is that they're continuing to compare inflation today as if it were being measured in 1980 dollars. So they compare it to 1980, and it's, we're at the same level or just above. But the reality is, if we calculated inflation as we did back in 1980, we'd be above 17%. So I don't think it's going away. And if they're at 2.5 on the high end of the Fed funds target rate, and you're basically 600 bips below where the government's watered down version of inflation is at, but more like 1,500 bips, 15% below where real inflation is, they're not going to stop inflation. But like as you were showing, Chris, with the I pulled up the live webpage for usdebtclock.org, and you see how much debt there is. So they're really stuck between a rock and a hard place. I think they're going to have to crash the market and the economy. So we have yet to see that occur. Okay. And I would remind everybody about prior bear market rallies. Bear market rally, I heard some guy on TV, oh, this is a hated rally, and hated rallies don't end well for the bears. Well, BS. Every bear market rally is a quote hated rally, because it's essentially a technical phenomenon. As I said before, as you progress through a bear market for several months, analysts lower their estimates for companies. And so as you have each earnings season, there's a potential for companies like Walmart, for example, to just come in with something not as bad as expected, and they jack it. But if we look at this in the grand scheme of things, you still got a ways to go. You're above the 200-day line. And frankly, if Walmart had announced the same numbers a year ago, it would have been a disaster, and it is. So it's all technical relativity here, and I think you get shorts in stocks, and so they're forced to cover, and then you have the retail crowd, because we've seen huge spikes in option volume, call buying by the retail crowd, whereas the institutions are not really jumping in here, and that's why it's been more or less a melt-up rally. All the way, because you don't really see huge volume spikes on the way up. You're just kind of drifting higher. The bigger spikes have been on the selling. So we'll see how this plays out. But I'm not. I think it's starting to get too bullish, and this is generally in a bear market. They get everyone bulled up, and then that's when they pull the plug. So if it is a real bull market, it'll take it. It'll develop in time, and I don't think there's really a reason to feel like you got to be jumping in necessarily. But I would point out, if we go back to 2000, here's the break in the NASDAQ off the peak. It's a pretty sharp break, 40.1% in just a couple of months, really. And then you bottomed, you undercut the low there, and then you started up and you had a follow-through day on June 2nd. Chris and I were on the floor of the New York Stock Exchange on that day. We were eating breakfast in the lunchroom with our floor brokers from O'Neill, Louis Silcente and Steve Papora. And the jobs number came out and it was really strong, because people were thinking, oh, you're going to get a weak jobs number because of the way things were playing out in the market. And it was strong. And so they had to leave breakfast and go down to the floor, because we had a flood of orders coming into our institutional desk. When Chris and I got down there, probably about 10 minutes before the open, things were pretty nutty in our booth. You remember that, Chris?
Oh, yeah.
Yeah, and when the bell rang, and our booth at O'Neill is right underneath the bell, so when they ring the bell, man, it like practically rattles your head off. But immediately you just heard this huge roar. It's like this din, this loud din, and just going around. And I remember I had my dad with us, and he was like sitting there with his mouth wide open, like, holy cow, what the hell? Is this what it's like all the time? And I said, no, not really. But today's an unusual day. So it was a good day for him to see it. So he got a kick out of it. But in any case, that started this bear market rally. And you had one peak and then a break, and you undercut some lows in here. And then you rallied back and double top, and then you broke down hard. And in June, Bill O'Neill got very bullish and called a new bull market. It's a brand new bull market phase. We're starting all over again. Everybody load up. And based on the October 1962 precedent, after the Cuban Missile Crisis, when that was resolved and then the market took off. But things were so much different then that I don't think you can compare apples to apples here. It's more like apples to walnuts. But once things ran out of gas, right at the beginning of September, right at the end of August, however you want to look at it, the market blew apart on a new leg to the downside, and that was a brutal downside leg. And Chris and I tend to think that this is what you're looking at. I mean, we'll let the market tell its story, but it could go on for a little while longer, possibly. I don't see how, but I guess it could. But I definitely watch to see what happens after the minutes come out, because I do think that as Chris was saying, the market rally gives the Fed room to hit it again. And I guess the benign data in terms of, I don't know, the jobs number we had, but the New York Empire State Manufacturing Index came in at minus 31.3 when they were expecting 5.0, down from 11.1. That's positive. So that's showing you we have a very rapid collapse. in any case. If you go back, if we go look at 2008, no, let me just move. Summer rallies, bear market rallies are typical. You have the same thing going on here, where we rallied into, keep going here, 2008. Here we go. Yeah, spring summer rally. So you had this rally, got a little double top in here, and then we broke down in June to July, and then we rallied one more time into the 200-day line, and then you blew apart. So you can see in these cases, you have one rally up, and then it breaks, and then it might retest those highs. I tried to do it here back then, but it didn't quite do it. And some people are trying to make a comparison to durations. Just forget that BS, okay? You just watch what's happening in real time. And when you have a break early in the year and you have a summer rally, a lot of times they end in September. And this one actually ended in August and then gathered momentum on the downside in September into October. So we'll see if something like that doesn't play out today. But in terms of individual stocks, I don't see anything that gets my blood boiling. We put a report out on Cameco, which I think nuclear power is, once all these politicians realize that electric vehicles and solar panels aren't going to cut it, they're going to go to cleaner energy in terms of carbon production and go to nuclear. And there's actually, you can go online and search on the internet for the newest technology in nuclear reactors, and they're actually very safe because they use a completely different configuration. There's actually some good videos on it in YouTube, but Camco's holding up here in a base and looks okay. But if I'm looking to buy it, I would want to do so along the 20-day and the 200-day. So you had a pocket pivot yesterday, very subtle, but it's not going to go anywhere today when the market's down. So you can just kind of throw that one out the window. Let's see. Let's see if we got any worthwhile questions. DT and Bed Bath and Beyond. Well, why are you asking us? What are we supposed to tell you? Are we supposed to approve your trade? If you think you see a double top in here and you wanted to hit it at the right spot, then go ahead and do it. But why do you need to ask us? If you understand what the setup is, why do you need to ask us? I always think that's kind of weak stuff. If you know what the setup is, if you know what the entry is, and you know what your stop should be, if you've been paying attention to how I discuss handling double tops, why do you need to ask us? As if you need our permission. Seriously? So wait a minute. Let me go back. I did the wrong one. One more B in there. Yeah, there you go. So, if you want to short this, what are you using? I guess you'd use one of these highs. So you know what the trigger is, but it's kind of late now. You had to do it earlier today. But it's hard to get in the way of these meme stocks. So, but I'm not going to tell you what to do. Watch the setup. As Bill O'Neill used to say, don't ask everybody else what they would do. Just do what you need to do and figure it out. In any case, and I also wanted to make a point. Someone emails us. They want me to explain or want us to explain the indicators on this chart. It's like, you cannot be serious. All you have to do is go on the internet and you can search for bongo indicator and you'll see definitions for it. Search for kahunas. Even though it's an HGS investor indicator that Ian Woodward made up, it's on the internet. Force index is something that Dr. Elder came up with. He's a guy who wrote the book, Come Into My Trading Room. Look it up on the internet. I'm always amazed at how people are so lame. It's like they lack a basic resourcefulness. And I think a strong trader, a strong investor has the ability to nose things out. And it's amazing to me when you have this thing called the internet, where you can just search on things and find out what you're looking for right away. And yet people have to send us an email asking a question. It's like, are you serious? Come on. Are you that dumb? Are you that lame? Are you that lazy? Or are you just plain stupid? Okay. So, pardon my French, but I think learn to use the internet. If you want to know what the indicators are on here, then go to HGS Investor. They'll tell you everything you want to know. If you see some indicators in here, what is MACD? What is this? Look it up on the internet. It's all there. Anyways, I think that, because I'm always a little frosted by the fact that people think, our time is so worthless that we're going to sit there for 20 minutes writing out a bunch of descriptions of what the indicators are. In any case, do you see stocks rallying off the lows? Let's look at agricultures are trying to hold up. The fertilizers are, but some of these look double toppy to me. So I'm not necessarily a big fan. So nothing really going on there. If we go down here and look at semiconductors, we look at the big stocks. A lot of these are in double top positions, or they were a couple of weeks ago. Analog Devices came out with earnings this morning, and they're blowing up. Now you've got a double top trigger here on the short side. So none of this looks good, and you've got all these guys now. Everybody's bullish. The S&P retraced more than 50%, and that's no bear market has ever done that. Well, you didn't see the markets in 2000. The NASDAQ retraced way more than 50%. And to ignore the NASDAQ and focus solely on the S&P to make some grand market call, to me, just seems stupid or deliberately ignorant, because a lot of the movement in 2020 to 2021 was in NASDAQ-type tech and growth names, so let's just ignore it. And once the S&P retraces 50%, we'll get all bullish. Here's KLA 10 core. Looks like it's a failure. Here's a short at the 10-day. So you'll notice this pattern overall is really nothing. Okay, but you get a sharp rally. Okay, and that's typical of bear market rallies. It's very difficult though to find an entry point unless you come in on an undercut and rally down here, and even that is a little bit shaky. Okay. And then as you come up into, you got these highs over here, you got this high here. This high becomes your reference for a double top short. It hit it last week, and then you rally right back into that and the 10-day line, and that's where you hit it again. So, pretty straightforward. And there are a lot of these around, especially among semiconductors. Look at Lam Research, the same situation. Lumentum got close to this high, but now it's blowing up, and it triggered as a short at the 200-day line yesterday. So you can see a lot of this coming. I think the market's going to hang out here ahead of the Fed minutes. Microchip technology, there's a double top right through this peak here on the left side, and also the 200-day line. So if you saw that, bingo, shortable. But who knows if it's a one-day wonder trade or something greater, we'll see. Qualcomm, short at the 200-day line. It's trying to hang in there along the 20-day line, but my guess is it's going to roll if the semis roll. Seagate, a little double top there last week. You can see that. Texas Instruments, a very double toppy here, but look at this. You can see how it approaches this high, but it never quite gets there. And then you can use this peak here as a reference on the left side here. So that would be this one. And now it's breaking below this peak, and it's holding right at the 200-day line. If it breaks it, that's another short sale trigger. So a lot of these were actionable over the last few days. So even though yesterday looked like a benign day, I'm actually able to make pretty decent money on the short side for the last couple of days. And that was telling me something I thought. Western Digital, a short, breaking down at the 50-day line. So let's look at solars. These have been hot because the government's going to give away $369 billion in corporate welfare to the clean energy industrial complex, which in my view, the clean energy industry has just found a way to ally themselves with government and use policy to their advantage, much as in the same way that the military or the defense industry allies itself with government to make money every time we fight a war, like sending, and even proxy wars, like sending weapons to Ukraine, which to me is just a black hole. But in any case, that's another issue altogether. So Array is coming in. And I think most of these, these things were doing nothing until the news came out that Senator Joe Manchin was going to reverse his position and support the bill. So they all shot higher. Now they're all starting to approach double top land. I'm not really interested in the Chinese names. I do think Daco New Energy is a short here at the 10 and the 20. But Chinese names I don't really play with because you can't margin most of them now. I guess because there's a risk of delisting. End phase is interesting, and you'll see here you have a move straight up from the bottom. And again, a lot of these patterns were quite moribund. If you look at this, it looked like a big head in here with a bunch of shoulders, okay, and it was hanging out here. And then Manchin says that he's going to shift sides. I think actually they did pop on earnings, and then they got extra boost here from the Manchin news. But you come up just above the $300 level, 200% above. You get to a high of about 306 and change, and now you're breaking down through the $300 level. Right now you're trading at 289.50. So that actually became a Jesse Livermore short sell entry at the $300 level yesterday. And now it's below the 10-day line. So if this is going to play out as a pod-like maneuver, because if we do look at the weekly chart, I'm just going to quickly switch to a weekly chart here. You're down here at 100. You did have a 50% break and then an instant move to new highs. The same thing happened there with First Solar. But you have a double top reversal today. It actually peaked out this morning. You hit a high of 121.91. That's within about, 1% or so of the 123.12 left side peak over here. And now it's reversing. And if it busts a 10-day and the 20-day, then you have a full-on punch bowl of death short sale setup. And again, this thing was dead in the water when Manchin changed his position. And then they also came out with earnings which were better than, or not as bad as expected. And it shoots straight up in 4 weeks. That's insane. I don't think I've ever seen a pod, Chris, looks like this. I thought the one I played, Ariba, I played on the long side coming up the right side, and they got too heavy at the top and got whacked off the peak because the market broke hard in September 2000, as you saw. But this one is just kind of absurd. But if we look at it on a daily chart, you can see that once you break the 10-day, that's your first aggressive short entry. But it's also possible to stalk it up here, and I have been doing that. And you get $2 or $3 or $4 on the downside, nothing really to write home about. But I think once you break the 10-day line, then perhaps all hell breaks loose, and then you would look for a quick break below the 20-day line, which is sitting at about 100 and change. So, that's I see a lot of setups on the short side, and a lot of them are very typical of what we saw in 2000. A lot of double top type action. I'll tell you a story about, I think the only stock, and tell me if you remember anything differently, Chris, but I remember the only stock back then that was breaking out was Corning Glassworks. And back then, fiber optic was coming into vogue. And so, Corning actually had a pretty decent move coming off this base after the follow-through day in October, late October of 2000. Late October of 1999, and it had a huge run. And then, March came and it broke down, but then it set up in this odd looking, what I called at the time, an udder with handle type formation. So now I got to go back again. But it's this weird looking base right here. Look at this thing. It was like, so I called, it was like an udder with a handle, and because it was kind of weird long weekly ranges, which expressed some of the volatility of that time. And then it broke out, and it went up 69%. Okay. And that was one of the few, if not the only breakout. And what was hilarious is I was able to buy this in my personal account and play it. But Bill, do you remember this, Chris? Bill hogged it for himself. He would not let any of the other internal portfolio managers buy it in the firm accounts that we
frustrating. Very frustrating.
Yeah, it's like, I was giving him so much crap about that. It's like, you hog, you're hogging it. And he would just smirk and say, well, I bought it first. It's like, okay. Anyways,
that was Bill.
but the thing to keep in mind here is that looked great, okay? And it was a name that you could make money on the long side. So you can make money in bear market rallies. You just have to kind of have an idea of what you're doing. And if you know how to use undercut rallies or voodoo pullbacks within uptrends to buy, then some of these things are playable. But I think the environment is so toxic, there's so much potential for black swans that it makes it difficult for me to hold anything overnight without having at least a small position in the UVXY just in case the world blows up the next day, But you can see that once, and this is what made this thing so treacherous, is that, okay, you did get a 69% run up here. But if you hung out too long during this week, you gave it all back in 1 week, okay? And that's what happens, because bear market rallies are mostly technical phenomenons. They're not necessarily powered by money flows into the market and institutional buying. And that's exactly what you're seeing now. You're seeing the retail crowd coming back, which has been pummeled, okay? People have taken huge losses. They've got taxes due that they don't know what to pay them with because they lost all their money in 2022. And so what we see now is credit card debt is spiking, and it's been doing so for the last several months since the beginning of the year. And what that speaks to, in my view, is that you have the retail investor, which is where all the buying and the call buying, you have spikes in call buying during this rally off the June lows, and so they're coming in and they want to make up their losses from I'm going to say the last year and a half, because all of these SPACs and all the other meme stocks and all these the EVs and all the innovation stocks, like the Robloxes, the Upstarts, the Unity Softwares, it all blew apart, the snowflakes. And so they're coming in and they think they're going to make their money back. And I remember this was the case back in 2000. And they got people going, but when it broke hard. And I think what happens here is you get a lot of call buying that it's just a retail crowd, and they can push it up because they did that in 2020. And but I think this time they're going to run out of gas a lot sooner. So we'll see how this plays out. But that's basically what you're seeing. And maybe we can just look at a few other groups here. What are other big groups? Any particular groups anybody wants to see? Miners? Miners are trying to come up. Gold and silver have been rallying off the lows, but my guess is if the market remains weak, they're going to get sold off, and they'll become sources of liquidity as well. Same thing with Bitcoin. It looks like Bitcoin looks to me, well, we can just use the GBTC as a proxy, but if we look at this, I'm on a weekly chart. Yeah, let me go to a daily. You're breaking down through the 50-day line, so that looks like a short trigger to me. So if I want to short this here, I use the BITI, the BITI. So this is what the BITI looks like. And, oh, look, it's an undercutting rally, which I wouldn't pay attention to. Just if you think Bitcoin is going to break, you reference the Bitcoin chart. And if it's breaking the 50-day line, then you use this as a vehicle to play it. Don't worry about the pattern here, because it's going to be a little odd, I think. And this thing is really only designed for day trading. From what I read the prospectus, that's what it's intended to do. In any case, how about some groups? I like this. Oh, I got to give this comment the award for the best comment of the day. We heard from Walmart that the Dr. K's and Gilmans of the world are being forced to shop with the smelly Walmart people. No, I do all my shopping on Amazon. So, and yesterday, my wife asked me if I had anything to give to the veterans, and I gave her like 20 of my old tailored suits, which I don't wear anymore. So it's hard to
I don't know
believe.
when I went. I don't know when I went to an actual store. I have not gone into actual stores
Yeah,
in years.
what do you need a store for in Walmart? What the hell's Walmart? Can you order online from Walmart? I think you can. But
You can, yeah. You can have everything delivered. I have everything
yeah,
delivered. When I was in LA, I went shopping once, and it wasn't for me. It was because, yeah. So I've never really gone shopping for a number of years in the conventional way.
Me neither. Yeah, I mean, shopping in stores is so 1990s, man. It's like, come on, seriously? But anyways, I was just laughing because my wife asked me to clean up my closet. I just noticed, I have all these suits. There was a time when I had 40 tailored suits, over $100,000 worth of suits. So I could go for a month and a half, almost 2 months without wearing the same suit. But then at my desk at O'Neill, because O'Neill was so cheap, it was so bare bones there. I had this desk that was a metal desk that was so old, it had sharp edges, and it kept catching my suits and ripping them. And I kept complaining to Bill, and Bill said, "Well, don't wear suits anymore." And so I did, and I stopped. And then that's when the whole everybody else in the department started to come in just wearing button-down shirts and khakis. Remember that? Even Bill came and started coming in, because it was when I first got there. And you too, Chris, it was pretty formal. People always dressed up in suits. Remember Bill McGann, the old guys would all be in their suits, but I just remember that. So no, I don't
remember
anything anymore.
All right. I started coming in sweaters, and yeah, it's just like I pushed the envelope there, and it was okay. It was not okay.
Well, we chilled that place down a little bit, a couple of notches. Anyway, somebody once asked about oils. That's a good area to watch. I need to. Uber's coming down. That's been a good short for me too. Okay, the oils. The premise of all of this is higher oil prices. Now, I got to tell you, I think oil prices are likely to go higher eventually. But in the short term, you're having this demand collapse. So that brings oil prices down, and they correct oils. But if we look at oils, what's the let's just use the ETF, the XLE, because they all pretty much look the same. But if we look at this, this was already discounting higher oil prices a long time ago, and then it went parabolic. And remember when the oils went parabolic and oil went parabolic, everybody was talking about $175 oil. That's right about when you can figure the top is in. Just like they wrote a bunch of articles about aluminum shortages right at the top, copper shortages right at the top. I guess the latest one is lithium. But you can see now you're in this big head and shoulders. Is it going to hold? Or are we going to turn? I think you could see the sector break lower. That's definitely a possibility if the market heads lower. So in some cases, I think you're looking at potentially short sale entries, possibly along here. And I would use ETFs. What's a good? Is it Gush? No. What's it? Or Drip? Is that? Yeah, I would use this ETF, Drip. That looks like fun, actually. Maybe I'll mess with that one, Drip. I like that. And the trade's pretty thick, right? 4.2 million shares so far today. Ooh, I'm going to have to mess with that one. Okay, other stocks, what do you, SCO, what is that? Okay, there's that. That's for crude oil itself. That's a possibility. I think you're a little late, though. I don't know. But as I was saying, USO could be in a head and shoulders along with some of the oils. So if we look at the XLE, you got that big head in the middle, and then you may be in a right shoulder zone. But I must say that does look interesting. What other ones? MRO is what? Marathon Oil. Yeah, you'll notice they all look like the XLE, and I can go through most of these. Denbury is one exception, but it may be in double top land. Trying to think of some others. OBV is one I have liked, but that looks like it's going to be a short. I actually tried to short this one earlier and also Denbury, but I couldn't get a borrow. Interesting. But so that's my take there. I think if the market goes lower, these guys are all going to bust, and it's going to be bye-bye to the sector along with everything else. So anyways, so I think probably this would be your ripest area to look at. I would also look at the coals. So you have Arch Resources. Let's just take a look at these. Because what will happen is if the market comes off, and of course the context for this has to be the market coming lower and a new leg developing. But you look at a lot of these. Let me see if I can make this a little bit bigger. Again, these had a big move, and now they've just been these sloppy kind of domey type patterns. But this is pushing into an area where it could run into some resistance. But if we look at the other names in the group, CNX is a short at the 200-day line. Probably Consolidated Energy, CEIX is going to be a short here. I think if you see the group breaking and the market breaking, something like this then becomes an aggressive short sale entry at the 10-day line. Peabody Energy looks a little double toppy, BTU. Ramaco, that's just a dog. Here's another one, Warrior Met Coal looks a little bit double toppy. So I think that's an area to look at. What other areas have been on fire? Well, we talked about well, we should go to back to the solars. I think I kind of slipped out of there for a second. But again, I think I'm going to stick to, but you can see Dayco looks like a short. I'm going to stick to the US-based name. So Enphase was a short at the $300 century mark yesterday. Now, you get a second aggressive short sale entry at the 10-day line, but a true punch bowl of death formation will bust the 20-day line. Because if it's going all the way back to the prior lows, as these will do during another leg down in a bear market. So you need that context going on too. The 20-day line becomes the real, line in the sand. And once they break that, that's it. And I think you're going to see that potentially in First Solar as well. And this move, I just look at this, it's freaking insane. But that's what happens when a bunch of retail investors all pile in buying calls. And they have seen huge money flows into the TAN ETF. Does anybody know of an inverse ETF for solar? So Solar Edge, that's a late stage failed base. So you see the failure here. Boom. And then, of course, textbook bounce off the 50-day line. You also have the 200 in there as well. You rally up to these highs along the 10-day, and now you're breaking down again, so it triggers as a short once more. SunPower is coming down below this left side peak, which is at 25.24. Right now you're at 24.80. That's a short entry right there using 25.24 as your cover. Okay. Somebody wants to look at healthcare. Do I even have a healthcare? Do you have any specific names? It's not really an area that I'm interested in, to tell you the truth. I can pull some out of the top of my head. HCA. Let me check something over here. I might have another list of healthcare names. Here we go. So that actually looks like it was a short at the 10-day line. Some others in the group, Humana, it's hanging up there, but I'm not going to buy this. So, but if you think you're setting up and you want to take a long entry using the 10-day line or something as a selling guide, I suppose you could do that. But why bother when the Dow is now down 280 points and breaking hard off the peak? And some of these are holding up. Like I also see, United Health is doing the same thing. So, but you're kind of in the double top zone. So I think what you watch for, if the market continues to break lower, you're basically creating the context for late stage failed bases. So that's probably where I would what I would be looking at. So, anyways, I've gone on too long, and I chewed you all out for not knowing to use the internet when you're trying to find out about something. That's like on my Twitter page. I use DTSS, double top short sale setup, right? And then you'll get people tweeting back, DTSS, question mark, please explain. It's like, hey, moron, go onto the internet, type Gil Morales or type VoSI, whatever, and DTSS. And guess what? You'll actually find a definition for it. So it's like my kids used to tell me when they were 4 years old, and I'd ask them a question about something, and they'd look at me and kind of go, sigh, and say, Dad, there's this thing called the internet where you can find out stuff. So that's what I would say to anybody who asks questions that are easily answered on the internet. So use it. It's a great resource, right, Chris? I mean, I can remember when we used to hang out at my house in my office, and you first showed me Google, and you said, you got to use this Google. You got to Google things. Like, I'm like, Google thing? What are you talking about? It's like, so you showed me the Google page, and then I started using that as my search engine. That was a long time ago, baby. Anyways, so I think you're breaking. I think you're topping, and I showed you some things that are in shortable positions, some things that may start to develop in shortable positions. So, for example, you look for the punch bowl of death type setups in First Solar and End Phase, wherever else you might see them. Like another one is this Celsius Holdings. These guys make an energy drink. Is that correct? Do they make something else? Is there something I'm missing here? Consumer staples, beverages, and I noticed they make these energy drinks. So what? I make my own energy drink. It's called green tea with ginseng. Anyways, if you look at this on a weekly chart, you're going to notice, well, it's because it's a logarithmic chart. You can see you go down below 40, but you came down from over 100. So that's deep enough for a punch bowl of death, and you go straight up along this side. So now where are you? You're below the 10-day line, so you had an aggressive short entry there. If you're really on the ball here, you had a double top entry as it approached the prior peak here. But now you have a short entry at the 10-day line. That would have been 3 days ago or on Monday. If you bust the 20-day line, that's again the line in the sand for a punch bowl of death type of setup. And remember, it's going to break hard within the context of a new bear market leg. That's how these tend to work, okay? You get the rallies up the right side in some of these, and we've seen that in First Solar, in End Phase, and this one, Celsius Holdings. If you find any others, you treat them the same way. They run up so fast, the move is not sustainable, okay? Because it doesn't take any time to consolidate the move. And so you get this, straight up look on the weekly chart. There's no real, from here to here, there's no real consolidation. So the break will be very rapid. And once you see that 20-day break, that's usually when it happens, and it will happen in concert with a bear market rally failure. And so this occurs during a bear market rally. It's exactly the way I've seen other pods set up during a bear market rally. Everybody wants to get bullish. Once everybody's bulled up in the bear market rally, then you get a new leg down in the market, and that's when these things blow up. So remember, if you play a pod It's got to bust the 20-day line. You can get aggressive either at the double top highs or at the 10-day line if you can handle it, and you might have to test it a couple of times. But once you start to break that 20-day line and you have the context of a new bear market leg to the downside, you're potentially in Fat City, okay? So if you do try to play one of these, that's how you do it. So with that, I'm done. How about you, Chris? You got anything else?
I think we're good, and we're seeing the market roll over as we speak.
Yeah,
so
down
let's see
306.
how far it progresses. Yeah, again, I don't think the minutes. I don't see why they would be. When the Fed reported and they hiked 75 basis points, the first time they did it, the markets tanked over 3 days, and Ethereum lost almost 50%. And the second time they did it, which was the last time they hiked 75, the markets rallied because it was a perfect storm. There was so much short interest out there. Markets had already come down a long way. And I guess there was no way to go but up because the markets were clinging to any kind of hope from Powell. And he did say that, if inflation moderates, he might go a little easier. And it was widely anticipated that the CPI, PPI would moderate, which they did. And the question is, will they continue to? And they very well could.
I don't think
and
so.
so that might,
I don't think
that
they
might
moderate, Chris.
well, I
Because,
mean, what I mean by that is coming off a peak. I don't mean they're
okay.
going to go down
Oh, I see.
permanently, but I mean, yeah, just coming off a peak. So if they do that again, like they come in below expectations by a little bit, like they did this last report. It gives Powell more room, a little more breathing room, and he can, then he can say, well, like, okay, we're not going to hike 75, we're going to hike 50, or we're not going to hike 50, we're going to hike 25. And I think the markets have already bounced quite a bit, so I don't think we're going to get a real sharp continuation of the trend on that kind of news. I mean, it'll push markets higher, but I think on fumes, and I think that's where the markets are now. They're on fumes.
Yeah, I would agree. All right. Well, anyways, thanks for showing up, everyone. We will talk to you next week, and let's see if we get a new bear market leg to the downside. Tis the season, so we'll see. Take care.
So long, everyone.